Hello, my name is Claudia Schmitz from Zenandu Learning Agency. One of the big topics is a small one. It is about depreciation. We use it as it is something we eat and drink every day, but actually, nobody really knows what depreciation really means. It is something with loss of value, but the thing is standing there, it looks the same. Where is the value gone? And I think I try at least to give you an idea, and I show you some slides I have prepared and give you a short introduction on what I think is depreciation. So we have two words. It is about depreciation and it is about amortization. So they are two words and they have a similar meaning but used differently. And I explain you first depreciation. So what we know about depreciation is that there is a value is shrinking over time. And here is an example. We have some 16 million in the beginning, and every year we deduct 25% of it. So at the end, there is 5 left, and in the 5th year, it's depreciated, it's done, it's zero. So you see, when you do this in percentage, it's slightly going down. And there is another way to do it. This is if the same value is depreciated every year. So it is not in percentage. It is like 5 million, or we deduct it into 5, and so it will be 5 million every time. And the last version, so we call the linear depreciation, is used in companies who are reporting to IFRS standard, International Finance Reporting Standard. And this standard is standard for most of the companies who are at the stock exchange. So they have to do it. So it's linear, it's always the same. And why is it standard now? Because if you have it all the same way and no choice, you can really compare from one company to the other. And this is a so-called overview finance transparency for shareholders. And this is why we have this now. But what does it really mean? I think if I do it a more practical way, I usually ask people, what do you buy with a value of 1 million? What machine or test machine would cost 1 million? So here are some pictures of test machine for quality management and so on from different companies. And this is how such a thing looks like. So you have discussed it with the management to buy it. The capex was allowed to be done. The business value was okay. And now you have to put it into place. You buy it from the supplier. And this is something I would like to show you. So we will buy the machine for 1 million. And of course, the money will go to the supplier. Usually we do this in 3 times. You pay an advance payment, you pay when it was delivered, and you pay when it is tested and run for the next 6 weeks, something like this. So you now go and have to do some books checking, and it is you have to know how long should it run. And you have to go to operations and ask the first question, how long do you want to use it in operation? What is the time over the years? And most of these machines run about 10 years. So we have 10 years now, and this is step 2. And now we say, okay, if I have the machine and it is running and it is tested, it has to go to the values of the company. So we book it in the values. And after that, we go into the profit and loss statement, which we know already, where are the costs. And we say, okay, if it runs 10 years and it has cost 1 million, we will have to divide it by 10. So for every year, we have a calculated cost of 100,000, just not in the last year, but I explain this later. So we know now the cost for each year is calculated on 100,000, calculatorical cost. And now in the balance sheet, we activate this 1 million and it goes to book value. And what we do is now, if every year 100,000 is the cost, we would use the value by this calculated 100. So the first year it is 900, the rest value, minus 100,000, 800, till it goes down in the last year when you have the 10th year, which you would like to use it, then you have 999, and in the value of the book, it remains 1 million. And this is why usually it would be zero. But if a computer machine sees zero, it means nothing. But the machine is still standing there. We didn't sell it, we didn't destroy it, it's still there. So the book needs kind of information. There is some object with no value. So this is why we have the one there. Okay, we have one. The machine is there, still running. And you ask in operations, or I don't think so. So it keeps running. Let's just say it keeps running. So you use it in the 11th year, and then the cost of this using is zero because it is depreciated. And we can do this for the next years and it will still be zero. So you need good maintenance to keep the machine running. Perhaps you need some more new software, but in general, it's not a problem. If you keep the machine in order, it can run for a very long time. If I go to companies, most of the time, the machines I see, I have a slight green color. And this says, oh, they're quite old. They must be from the 80s or the 90s. And this means they are more than 30 years old. If they're still running, it's fine. So the question is, if you have no cost, it's fine. Some people always think, oh, no, you have to depreciate something. We come to this later. So first, it's okay. The machine is running. We repair it, we fix it, we keep it, and this is good. This is even good for the future because then we have circular economy and we build things to last. So repair, maintenance, this is the new normal. Okay, so now we have all this, we use the capacity, we have, everything is fine. And all of a sudden, might be that there was a problem in year 6. Let's just think about it. So if you see, it could be that you say, we don't need this test machine anymore because we don't produce a product. So we have to either sell it or whatever, but in the books, the machine is still with a value of 400, and this is still planned to run over the next 4 years. So you have to depreciate it. That means for year 6, you have to depreciate the 100,000 you have here as the book value, which is there, and you have to depreciate the other 400,000. So that means 500,000 depreciation in 1 year. And this has an enormous effect because you have not calculated this cost and all of a sudden they are there. Even you have paid everything before. It's not something that you need the money, but you have to calculate the cost. And this is what happens in the books later. I show you. Okay, so this might happen that there is an issue and you have to depreciate everything. So it can be that the machine goes broke and it doesn't work anymore, or you don't need it and you have to sell it, but even that. So let's think you had depreciated it, then you offer it in eBay and you sell it for 100,000. Then you create an extraordinary income of 100,000. Then you have to have booked this on earning. So another issue which I would like to share with you is amortization. And you can see already, this looks very much like computers. And all the software you have for that is licensed. You don't create it, you don't buy it as a tool or complete, but you buy the right to use it. So all intangible assets, which are licenses or things or patents, if you buy them, they are also deducted in their value over the time of use, but you call this amortization. And how does it look like on the balance sheet? We have the financial statement, the profit and loss statement on the left side, and the balance sheet with the assets on the other side. Whatever you do in the situation that you have to reduce value is first you have to buy it. So the first thing would happen is cash out. So you reduce the amount of cash on the assets and you book it where it belongs to. So in this case, it would be something real like plant and equipment, but it could also be the licenses. These will all be on this side. So all the values are listed there according to their value, which you paid for. Actually, you don't book something on your balance sheet which you did not buy. So if you create your own patents, they have no value unless you sell them, but then you don't own them anymore. or you license them out. So the value has to be established through a price. And this is what you find on the asset side. So let's say we bought the plant and equipment, and now we have to depreciate it linear over time. And this would be the 4 millions we have here. So then this is a cost factor, even if you have paid for it last year. So every year you depreciate, there are costs which have no cash impact. So you depreciate it, it's on the list on all the costs, and then it will, of course, reduce your net profit. And I have always a lot of people who say, yeah, but we need to reduce something because otherwise we pay too much taxes. So immediately they don't want to pay taxes. Okay. So if you don't want to pay taxes and you have a lot of earnings and you have to think about which intellectual good cost do we really have, you could do several things like what we see here. First of all, overhead. Well, you could think about if you employ a new IT person who finally goes into all this stuff and makes a check on what we do, or you employ somebody for sustainable development, how and where can we save energy. You can go and say, we will also employ people for future developments. We have to digitalize all our tools with services, so we need new people there. They get salary, and this will all increase the cost of development. So perhaps for the future, it would be much better to look what would help us in the future and which people and salaries do we have to pay there. So this is something very also with creating cost. And this will, of course, also reduce your amount of tax you have to pay. So you shouldn't look on machines, or I think this comes from cars. And cars are not on the balance sheet. You have no cost here on cars because most of the people in the companies get the car as a certain kind of salary. So it is a kind of bonus system, and they get the car is a cost which you would have here. So how do you do that? You lease a car. So you have a cost of a monthly cost or yearly cost of the leasing, and this goes into the cost here of overhead for a certain amount of people who get a car as an additional salary. If you have the car and you use it because a lot of people use it and it stands around to go from one plant to the other, then it belongs to the company, and then it will be booked here as the value on equipment. But usually you only have issues on the assets which create value and which belong to the value process to create a product and sell it. So this is the situation. And before you think you have to depreciate something, think about how do you invest in the future. Okay? Thank you very much. Bye-bye.